This video will cover how to measure value in biotech investing and investing in general with equity value and enterprise value. This is the second video in our series on how to invest in biotech. You can check below to see the first one if you missed it. And as part of this video, we're going to build a simple spreadsheet that you can use to analyze companies on your own. And we'll link to the spreadsheet in the description. And then as we continue to learn more concepts in future videos and build on them, we will add that to the spreadsheet as well. So last time we discussed one common way to measure value in finance, market cap or equity value. So quick recap, the market cap measures the value of all of the equity of a business. The formula for market cap is shares outstanding times market price, the price per share of the stock. So for simplicity here, we're just going to use the basic shares outstanding. In many cases, it's best to use fully diluted shares. We will talk about that later, but for now, this is the formula we're going to be working with. And again, so the market cap represents ownership, the total ownership of the business by equity holders. If you own a stock, you own a piece of the business, get a say in how it's run and a share of the profits, and the market cap is the total value of all of the shareholders. So let's just jump right in and we can quickly review how to calculate market cap. So last time we showed that you can find market cap on Google Finance. So let's go to Google Finance, type the name of the ticker in here, and then this is the latest stock price. So you can get the stock price here. You can also get the market cap from Google Finance, although they use the prior day's closing price. But because we want to learn, how to find this information and where it comes from, let's do a quick example of calculating the market cap using SEC filings. So again, we're going to use the SEC Edgar database, search for the company of interest, Series Therapeutics in this case. And remember, we have the stock price. You can't find the stock price, the updated stock price in SEC filings because it changes constantly, and companies don't file SEC filings, every second of the day. But you get the market, the shares outstanding from SEC filings. There's two primary filings where you'll find the shares outstanding. So one is the 10Q, which is a quarterly report. A company puts out every 3 months, every quarter, to show investors what its financial accounts look like and what its financial performance was like for the prior quarter. The other filing you'll use to find shares outstanding is a 10K, which is the same as a 10Q, but instead of covering a quarter, it covers a whole year. So let's just go into this most recent 10Q for series, and you're going to typically find the shares outstanding reported right at the top here. So you see 91.7 million shares outstanding as of July 28th. Typically, the quarter ends on June 30th or March 31st or etc. But it takes a little bit of time to file it, so they're going to report the stock price or the shares outstanding as of the latest time they could before they filed the actual filing. Okay, so let's take this information and we will put it into our spreadsheet. So 91.7 million shares outstanding. So put that here. And then we need the price per share. And then the latest price per share is $6.56. So I won't format this now, but I have another sheet that is formatted that we'll use later. So there's a market cap of $601.5 million for Series Therapeutics. Okay, just a super quick, simple example. Another thing that you can do is you can actually, Google Finance has these built-in formulas for pulling some of this data. So if you just enter here, go to Google Finance, and obviously you can only do this in Google Sheets. Actually, let me put the ticker in here first. So then you just pull up this formula, put in the ticker, and then I think the parameter is shares, and then that will pull the shares. So just to make it comparable, we'll divide it by 1 million. And then you can also get the stock price this way. I think you just put in the ticker and then you don't put anything after, and it'll get you the latest stock price. So stock price has moved a little bit. But that's just another thing that you can do to automatically pull some of that data instead of going to the SEC filings. But again, I wanted to show where it is in the SEC filings so you know that, because that is the source document. If you go to this site here, this has some of the other things that you can get with these Google Finance formulas. But let you take a look at that on your own. So here we go. We have the market cap for series. We know how to find the shares outstanding and the share price and get the market cap. There's a bunch of other ways you can get this information too. If you have some computer programming experience, there's a bunch of interesting services and APIs you can use to pull in financial data. Might make a video of that in the future if enough people are interested in that. But for now, we're just going to use good old-fashioned spreadsheets. Okay, so now we know how to calculate market cap, but what can we do with this information? So we'll take an example of an event that we looked at in the last video, which is the big change in the Seres Therapeutics stock price back in August 2020 after they announced positive data from their C. diff study. So last time we talked about how the stock moved on a percentage basis after this event. But what about the change in the market cap? How much did the market cap change? And then what can that tell us about the value of Seres programs? So I'm not going to go through the manual calculation of the market cap again, because I think one time is enough for that. I actually already calculated it. So here, before the data was released, they had 76 million shares outstanding. So remember, this was a year ago. They had fewer shares outstanding because after the stock went up, I think they sold stock. And generally, companies will do that after the stock goes up a lot because you can sell, you can raise more money and give up less of the company when your stock price is higher. So back then, they had 76 million shares outstanding. The price per share before the data was $4.64. So you multiply those together, and you get a market cap of like 300 million. After the data, the stock price went up to $22.7 per share. So that gets you a market cap of $1.7 billion. So subtract that, and the value created by this data was $1.4 billion. So what does that mean? If we tie that back to the concept we discussed in the last video, basically the concept that value is the sum of all the cash a company is going to generate in the future, that value, investors thought the future cash flows that the company would generate were going to be $1.4 billion higher based on this data. So why is that? So remember that the stock entitles you to a portion of the value of the company. The value comes from the future cash flows. And when a drug generates positive data, more positive than expected, investors then think that the drug is going to be more likely to be approved by the FDA. It's going to be more likely that this is a compelling treatment compared to alternatives, so physicians will prescribe this to patients. And then it's also more likely that insurance companies are going to cover this because it's an important treatment option for the patients enrolled in their plans. So again, positive data is super, super valuable. It's really the currency of value in biotech, and this is a really great illustration of that point. So we just covered this, but how did this change the perceived probability of success at a more quantitative level? Can we learn more than just, this was good data, so the stock went up? So if we can think about the value of the company before and after the data, and then we can multiply the value of the data, or the value of the company before the data, by the probability that it would get approved. And then we can sort of get a sense for ultimately what probability of success investors attributed to the company before the data. So here we'll have just a simple calculation of what the value of Seres Therapeutics is after FDA approval. So here we'll just take 90% probability of approval after good phase 3 data. That's just from general industry data of the probability of transitioning to FDA approval after phase 3, and then multiply that by X, which represents the market cap if the drug is approved, and then we take the current market cap, so obviously 1.7 billion that we calculated previously. So if you solve for X equals 1.9 billion, the value of Seres Therapeutics if the drug is approved. So now that we know the value of the drug, if approved, obviously subject to some assumptions, we can then go back and use the prior market cap before the data to solve for Y, which is the probability that investors gave for the drug getting approved before the phase 3 data was released. So here again, take the probability of approval times the market cap of approved, and then you get the market cap at the stage, in this case before good phase 3 data. So solve for Y, and then you get 18%. It's sort of a rough sense of the probability that investors gave of FDA approval before this good phase 3 data. And remember, the prior phase 2b study in the indication failed a couple years before. So investors really didn't think much of this program, and this supports that view, this 18% probability of approval at phase 3. But this is just a simplistic example, right? This isn't actually true, and you shouldn't make an investing decision based on this. This simplistically assumes that Series has just one product. In reality, they have multiple products, and they also have a platform that's capable of generating products in the future. And all of those things contribute to the value of the company. So we can't just conclude that investors' probability of success before the phase 3 data for the C. diff program was 18% because there's these other factors. But it just so happens that another one of Series products had a data readout, and there was a big stock move associated with that, right? So this here, if we go, I've already pulled up the 8K, but again, like last time, go to the SEC Edgar database, search for Series Therapeutics, then you can search for 8Ks, and then this is the 8K that came out around that data release. If you'll remember the 8K we looked at last time announcing positive phase 3 data, you'll see this one is much shorter because the news here is not great. The top line results of this phase 2b study of a different Series drug in ulcerative colitis did not meet the primary endpoint. And you actually have to click through to the press release to see that the primary endpoint was not achieved. And that is why the stock dropped so much. So what can that tell us about the value of the C. diff program and the value of Series' other programs? So to do that, we're going to, again, calculate market cap, but this time we're going to calculate the market cap here after this drug failed. Okay, so going back to the spreadsheet, and I actually just already had the market caps calculated here, so you guys don't have to see me go through SEC filings too many times. But we can take a look here at, so all of these are the shares outstanding, stock price, and market cap for Series Therapeutics at different dates. So this date is back in August 2020, before they announced their positive phase 3 data in C. diff. This is the next day after they announced their positive phase 3 C. diff data. And then this is September 2021, after the ulcerative colitis data revealed that the study failed to meet the primary endpoint. So we can right here see that the market cap after this data is 600 million compared to 1.7 billion after the positive phase 3 data in C. diff. So right here, we can quickly tell that a lot of the increase in value generated by this phase 3 data in C. diff was attributed not just to the C. diff program, but to other programs, right? Because otherwise, if the C. diff program hadn't changed at all, but the ulcerative colitis program failed, we wouldn't expect the market cap to drop this much. Now, there may be, I'm actually not as close to the data here for this company to know, but if there were some, manufacturing issue potentially that was the cause for failure of the ulcerative colitis program, and that manufacturing issue also potentially affects the C. diff product, then that could potentially explain, this drop. But without going into taking another look at the studies, we can't really conclude that yet. But I think it's safe to conclude that the market, when this phase 3 study worked, the market did increase their estimate of the value of the other programs that Series was developing, right? So it may have been that investors just ignored the company altogether after the phase 3 study failed several years ago in C. diff, or the phase 2b study failed. And then after this positive phase 3 data, investors said, hey, this company might actually be interesting. Let's take a look at the other programs. There's other interesting stuff going on. But it looks like overall there is a lot of value that was attributed to the ulcerative colitis and potentially other programs, and a lot of that value is decreased. So now it's tempting to conclude that the $600 million is the market's current estimate of value of the C. diff program, right? Now, there could still be some residual value attributed to the ulcerative colitis program, and there could be some value attributed to the other earlier stage programs as well. But the biggest reason why we can't say that the C. diff program is worth $600 million is because of cash. So market cap, or equity value, includes equity holders' claim on all assets of the company. And cash is an asset. So if Series had $600 million cash in the bank at this point, and their market cap was $600 million, that would actually imply that the value of the underlying business was nothing, right? The investors value the company at the value of its cash. And a lot of times when a company's lead product fails, investors do value the company sort of within, call it 10% or so of the amount of cash that the company has on the balance sheet. So market cap can't really tell us that much. It's not it's not a holistic, complete view of the valuation of a company. So what can we do to have a little bit more confidence in the value of the underlying company? So we introduced another metric here called enterprise value, right? So previously we talked about equity value, aka market cap. Now we're talking about enterprise value. So market cap is the value of a company's stock, but it doesn't reflect the value of the company as a whole. Enterprise value is a more holistic picture of what the company's worth. The formula for enterprise value is equity value plus debt minus cash. And then there's some other details as well that you add or subtract to get enterprise value, but those are sort of corner cases, and we'll talk about those in another video. But for now, equity value plus debt minus cash is enterprise value. So why does that even make sense? Why do you add up these things and get this metric, enterprise value? So basically what this represents is enterprise value is what the company would be worth if it were acquired, right? So if somebody came along and they wanted to buy out the company's existing stakeholders, what would that cost? Obviously you would have to exclude the acquisition premium, but that's sort of a common conceptual understanding of enterprise value. But basically it represents all of the holders or the claimants of value of a company. So think about if you buy a house, right? So if you buy a house, there's a couple ways that you can finance that. You can use your own money. So let's say you buy a $300,000 house and you put down a down payment of $100,000, and then you take out a mortgage of $200,000. So your equity in the home is $100,000, but the home is worth $300,000, right? It's worth more than just your equity value. So the total value of the home is worth the $200,000 debt plus the equity of $100,000. So that's why you add equity and debt. And then cash is subtracted out because it can be used to reduce debt. If you have a business with $100 million of debt, and you have $50 million on the balance sheet, somebody buys a business, they can just take that cash and just immediately eliminate the debt by $50 million. So that's the general concept of enterprise value. There's a good overview to learn more about the difference between enterprise and equity value here. And in general, there's really good online material about these sort of common finance concepts like enterprise value, equity value, and then anything accounting related. There's a ton of really good resources online that you can look up and Google around to find. We're not going to cover all of the details in these videos. We're just going to kind of give you the conceptual overview, but I definitely encourage you to take a look at some of those other resources to get a better detailed understanding of what these metrics actually are. All right, so how do we measure enterprise value? That's the concept behind it, but how do we actually measure it? So to do that, we need to have a quick introduction to balance sheets. So a balance sheet is one of 3 or 4 main financial statements that record a company's financial activities. The 3 main ones are balance sheet, income statement, cash flow statement, and then there's also a statement of shareholders' equity, but we won't concern ourselves with that much in the first several of these videos. So a balance sheet reflects a snapshot of a company's financial position at a given point in time. You can sort of think of it like a list of the company's assets. So assets include things like cash, manufacturing plants, and intellectual property. And then you also have the funding used to acquire those assets. So if you think of it like double entry accounting, you have the things you acquire and then the resources you use to acquire them. So let's take a look. Some more intuition behind a balance sheet. So one important thing to know about balance sheets is the balance sheets must always balance. And I'll actually just go ahead and pull up a real balance sheet here to show you this. So the 10Q and the 10K, again, are going to be the common sources here for financial statements. You can just go to the table of contents, find balance sheets. So every balance sheet is going to have this general outline. So the rows represent what you call line items. And then you have columns. Usually there's like 2 time periods where you show the company's balance at given time periods. And you're always going to have 2/3 main sections. So the 2 main sections are assets and liabilities plus stockholders' equity. You can say 3 because there's the liabilities and then there's the equity within this. But the important law about balance sheets is that the total assets are always going to equal the total liabilities and stockholders' equity. It's just a fundamental law of accounting. If you want to learn more about why and sort of the quantitative reasons why, you can search around and look it up. But basically, it's because, again, the assets represent the assets of a company, and then liabilities and stockholders' equity represent how you get those assets, how you finance those assets. So I'm not going to go through all these line items in detail. Again, Google around if you want to learn more. But basically, assets are things like cash, right? Property and equipment, if a company owns a manufacturing plant or office space or whatever. And then additionally, there's other intangible assets and things that are not included in series balance sheet, but are also important to be aware of. And then liabilities are basically things you owe other people. Debt is a very common one. So debt here is captured here. And then like accounts payable, stuff you have to pay employees and other vendors. And then you have the equity portion. So this is the equity capital that you raise. And again, assets always equal liabilities plus equity. So for a little bit more intuition, we can go back to the house example here. And this is sort of an example of why the balance sheet always balances, right? So when I say the balance sheet balances, that means that assets equal liabilities plus equity. So again, we buy the $300,000 house with a $200,000 mortgage, $100,000 down payment. The house is the asset. So, back to the balance sheet, you would have just say house, and then that would be $300,000. Then the liabilities and stockholders' equity portion, you would have $200,000 of debt. That is a liability. So you'd have debt, mortgage, $200,000. And then you have your equity of $100,000, which would be in here. And that would balance, right? So then this is maybe just sort of a sneak preview of other financial statements, but like you have other financial statements, the income statement, and then the cash flow statement, and they all sort of tie together. And an example of that is if you pay off $10,000 of debt, your debt will go down to $190,000 in the balance sheet, right? So this $200,000 will go down to $190,000. But because it always has to balance, your equity, you always have to balance, and then assuming the value of the house is the same, your equity will increase by $10,000 to $110,000. On the other hand, if the value of the asset changes, value of the home increases by $100,000 to $400,000, then your equity value is going to increase by $100,000 to $200,000. As in this example, you don't pay off debt, that stays the same. But the point is, everything still balances. So that's kind of it for the balance sheet for now. We'll just jump now into a quick example of how you calculate enterprise value using this information on the balance sheet. So going back to our spreadsheet here, I will show a live example of calculating this here because we haven't found these items before. So we have cash and we have debt, and then we're just going to focus on this column here because we have the most recent 10Q filing. So cash takes 73 million or 74 million, but also typically you include short-term investments because short-term investments are typically considered cash equivalents. So their companies usually have a cash balance, and then they invest some of that cash into things like treasuries, which are investments but are very liquid, so the company can access them easily. So for cash, we're going to use 74 million plus 140.5 million, right? So we'll just put 74 plus, what did I say, 140.5, and then that gets you our cash balance. So now we need debt. So debt can be a little bit more tricky to find. Yeah, the more you look, the easier, the more you'll get used to the terms that sort of signal to you that this is debt. But in this example, we have the short-term note payable, which is 6.3 million, and then the long-term portion of the note payable, which is 19 million. So we'll call it $25 million for debt. Again, if you want to learn more about how to find debt and how to accurately record it, it's a little bit more complex than what I just showed, but there's other resources online. But in general, you're going to look for anything like note payable or loan or short-term debt or long-term debt. And then in a lot of cases, there's going to be a short-term and a long-term portion. Sometimes there won't be. Sometimes it'll just be short-term. Sometimes it'll just be long-term. But basically, like if you see on a balance sheet, current liabilities or current assets, these represent any liability that's due within a year. So if you have a loan and part of it is due in a year, that'll go in short-term liabilities. Long-term liabilities will account for the balance. And then you'll also go into the notes of the financial statements. We'll talk about that later, but that will give you more detail on the debt. But for now, just a simple calculation of enterprise value. So the enterprise value of a company is equal to the market cap plus the debt minus the cash. So here we saw the value of Series equity. The market cap was 609 million, and the enterprise value of the company is 420 million. Okay, so that's how you find enterprise value and calculate enterprise value. So now we can take a look at the value of the enterprise value of Series Therapeutics to see what we can learn about what happened when this data was released. So the current enterprise value of Series is 420 million. The enterprise value after the phase 3 data in C. diff, but before the phase 2 data in ulcerative colitis, was 1.6 billion. So we can conclude that there was a lot of value after the phase 3. Investors said, hey, the C. diff program seems like it's going to work. We also think that this ulcerative colitis program is going to work, and some of these other programs are going to work. Because the stock dropped so much after the ulcerative colitis program, we can conclude that. And again, you want to look more at the data to be sure of that. But that's something just for the purpose of, as an illustrative purpose in this video, we'll conclude that. And now we can conclude that the value of Series $420 million enterprise value is probably made mostly up of the C. diff program, and then maybe some value of ulcerative colitis or earlier stage programs. But we're not going to fully examine this. But if you are somebody who is a technical expert in the microbiome field, or you're familiar with these indications, these markets, then this could be an opportunity for you to take a look at the value of Series, and maybe the market is undervaluing the C. diff program, or maybe they're undervaluing some of the other programs. It's hard to know whether they're undervaluing the ulcerative colitis program because we don't know a lot yet about that study. We don't really know what went wrong or the much detail about the data, but that's something that you can explore as a potential investment idea. If we just kind of quickly look through some of the press around this, it looks like that Series equity research analysts only attribute sales. They only basically are looking at the ulcerative colitis program and the C. diff program. They're not really projecting sales for the other earlier stage programs. I think like an oncology preclinical program that's pretty risky. And analysts are projecting $326 million in peak sales in 2026, which is not like a huge amount of sales. If you have $326 million in sales and that's the only product, a valuation of something around 420 million isn't super crazy. But again, in subsequent videos, we'll cover the details of trying to understand at a more precise level what drives these valuations here. So to wrap up, we're going to look at one other company, and we're going to illustrate the concept of comparables. So one way to value a company is on a fundamental basis. So this $420 million for a C. diff program, you could do a market build. You could project $326 million in peak sales, and then you can value the cash flows that are attributed to that product. But one way to sort of heuristically and quickly find the value of a company is using multiples, using multiples, which we'll talk about in the next video, but using comparables. So we're going to compare Series Therapeutics to what I think is its closest comparable, a company called Finch Therapeutics. It is another microbiome platform, orally administered drugs. I think these are fecal transplants. And their lead program is a C. diff program, just like Series. So they've actually completed their first pivotal study, and it did not hit the primary endpoint, I believe. Now, they think that there are reasons related to study design that can explain why they didn't hit the primary endpoint. But if you have a competitor who's developing another microbiome product in the same indication, and their pivotal study succeeded, and they think that they're going to be able to get their product approved with just that pivotal study, even if if Finch studies their program in subsequent trials and it succeeds, they're still not going to be the first to market for this program. They also have the second program is ulcerative colitis, which Series is their second program also, and then this is another earlier stage program. It's just preclinical stage for this asset, and then they have a couple other preclinical assets in different indications as well. So this is a fairly good comp. Same therapeutic modality, same stage, and then their two primary indications are the same. So one thing we can do is we can compare the valuation of these companies. So I've already gone ahead and spread the enterprise values for Series Therapeutics and for Finch. But one thing that we'll do first is we're going to look at the, how the value of Finch Therapeutics was probably developed at IPO. So when a company goes public, it's the first time that the company trades on a stock exchange. And one of the challenges is you have to figure out what's the price of this thing. The first time it enters a liquid market, how do you price the company? So one thing that we can look at quickly, we can see that Finch went public in March of 2021. If we zoom in a little bit, we can see that they've traded down since their IPO, and they traded down a little bit after the negative phase 2B data that Seres put out in ulcerative colitis, but not a lot. They didn't trade down as much as Seres. It could be that less of the value of Finch was attributed to ulcerative colitis because it was an early stage program, but we're not sure. We'll take a look at that. So now we're going to take a look at Finch Therapeutics. So we're going to look at their IPO prospectus. So this is another really helpful SEC filing, and you can learn a lot about a company from their IPO perspective. This is particularly interesting because this is usually filed for an IPO, right? So a company was previously private, and this is kind of the first big reveal that a company makes to public investors. So you can learn a lot about a company from that. So we're not going to actually do, I've already did these calculations, but where you find the information about enterprise value and equity value in an IPO prospectus is you have the public offering price here, which is $17 per share. Usually, you as an individual investor can't buy at this price. So this is what the first big institutional investors or sometimes retail investors can get into IPO. And then usually the stock jumps after the IPO, and that's when sort of average people have the chance to buy the stock. But for the IPO valuation, you use $17 a share, and then you scroll down throughout the prospectus to find, this is sort of called the box, this section here, but you find the offering, and then it tells you the common stock outstanding after the offering. So then use this and the price per share to get the market cap. Then they also have full financial statements in these documents, but they also include a summary here. So you can just look at a summary balance sheet, and then you can get your enterprise value data from that. So again, we went ahead and calculated this. But what we want to look at and focus on here is we have the valuation of Seres Therapeutics and Finch Therapeutics at the date of the IPO. So date of the IPO, you can see here, March 18th. So we see that the enterprise value for Finch is $700 million compared to $1.6 billion for Seres Therapeutics, which sort of makes some sense, right? Because the two main programs, the companies are both developing microbiome therapies. The lead indication for both is C. diff. Second indication is ulcerative colitis. And at that point, Seres was ahead on C. diff because they had a positive phase 3 data that they thought could support approval, whereas Finch had a pivotal study that didn't really work out. They were going to have to do another study. Maybe the product ends up being better than Seres. We don't know. But in any event, that study probably won't read out for several years. So Seres will have time to establish a strong market position by that point. So it does make sense that the C. diff program would be valued at a bit of a discount. And then we also saw that Seres was in phase 2B in ulcerative colitis, and Finch's program in ulcerative colitis was still in the preclinical stage. So again, it does make sense that there is a discount for that program as well. So that's sort of a high level way of how you would price something at an IPO. Obviously, this is a super simplistic example, and there's a lot more that goes into it. But the basic idea is you take similar companies, you figure out how they're valued, then you think about how your target company, in this case Finch, stacks up to those other companies on important aspects of the business. In this case, like the status of their clinical pipeline. So that's a quick discussion about how the Finch IPO compares to Seres Therapeutics, its closest comp at the time. So interestingly, the current enterprise value of Finch is higher than the valuation of Seres. So Finch is worth $550 million enterprise value now compared to $420 million for Seres as of, I think, September 1st, 2021. And that's sort of interesting, right? Because Seres still has their C. diff program that is had a positive phase 3 outcome and is slated to be approved. And Finch, their C. diff program is still a little bit behind Seres. Seres ulcerative colitis program doesn't seem like it's working out too well, but Finch's is still preclinical, and the jury is still out on that one. And because the stock did drop around the time, the Finch stock did drop a little bit when the negative data from Finch's UC program came out. It does seem like investors didn't like the read through to Finch based on that data. But there's something about Finch that investors still like more than Seres. So I don't really know what that is. I'm not super close to either of these companies. I haven't done a lot of work on their platforms, but if you are somebody who's microbiome scientist, or you're familiar with the indications that these companies are pursuing, this could be an example of something that you might want to explore further and see if you can explain the differences in valuation between these two companies, or if there's some sort of opportunity here where one of these is misvalued. So that's going to be it for the video today. In the next video, we're going to talk about how you can compare companies more broadly using multiples and some other factors. And again, we're going to use the concept we learned about enterprise value and equity value and apply them to some different companies and get a little bit sharper in terms of how we think about the valuations of companies. So thanks for watching. If you have topics you'd want me to cover later on, please let me know in the comments. If there's companies you want me to cover, let me know that as well. And thanks for watching. Hope this was useful, and see you all next time.